Hi, in this video, I'm just gonna quick to talk about investment returns. I'm gonna compare the three different investment assets like rental property, stocks, and bonds because those are the common investment people usually held. And so when you have the rental property, stocks, and bonds, you usually have different returns. So then uh, you because those returns are calculated differently. So if you compare, like a cap rate of the rental property to a yield to maturity of the bonds, you totally compare something apple to orange. That is really not relevant. So when you compare, let's say you want to see a income produce capability of those investment assets, right? You should compare their income yield. Let's say the income yield is like the rental property is the cap rate. Cap rate in just simply is the net operating income divided by the purchase price of the real rental property. Then the stocks basically you look at the dividend yield. Dividend yield is annual dividend divided by the stock price. Then the bonds is you use the current yield. Basically, is annual coupon payment divided by the bonds price. So when you compare these three different investment assets, you compare their income producing capability, you compare this cap rate to dividend yield to current yield. So if the rental property have a cap rate 5%, dividend stock have dividend yield 6%, and bonds have a current yield 3%. So you would consider the stocks have more better dividend income. However, if you want to evaluating the overall return of each investment, let's just say if you if you buy these different assets, hold for 3 years, then sell at the end. So basically, you should compare the rental properties IRR and the stocks IRR and the two bonds yield to maturity. So they are annualized total return. What does that mean is they consider all the income. They basically include all the income, and at the end of the capital gain or capital loss. So you basically include all the cash flows in this. Then it's time weighted also. So they are the same standard. So that's how you can compare them. So that's I have an example here for internal rate of the return. So basically, if you initially you invest in $250,000, if you have a cash flow income each year like this, so then you can calculate your IRR, which is your annualized total return. Annualized. This is each year you have a 56.72% annualized return. So when you compare the total return, you should use this one. This is the ultimately you can evaluating how good each the investment class will give you the return. If you let's say your real estate produce like real estate produce 10% IRR annually, right? The stock produce, let's say, 12%, then yield the bonds give you, 5%. So you still consider the stocks is more attractive. Of course, in the reality, you have many other things. Rental property, you may, have, you have to manage it yourself. But remember, this IRR, when you calculate them, they incorporate all the commissions, all the commission transaction fee as well. So that's a very good, the return tool to use when you in this investment evaluation.